we now make 10% provision that out of this 1,000 naira, Mr. A can only pay 900,000 naira. So in other words, we are saying 10% of that 1,000 naira, Mr. A cannot pay it. Remember, because Mr. A we sold goods to Mr. A in the first place, Mr. A account will be debiting account receivables and we credit sales of 1,000 naira, right? Great. Now, the account that we've debited, which is 1,000 naira as our account receivables, we said this person can only pay how much? 900 naira. He can't pay up to that 1,000 naira. So we now make a provision by saying that, okay, well, out of this 1,000 naira, this person can only pay how much? 100 naira. Then we make a provision by saying that we will debit our profit or loss account, provision account, by saying provision for doubtful debts, 100 naira. And we go to our liability, open a provision account, and also credit it with 100 naira. Now, the subsequent year now passed, we realize that this person, instead of paying 900 naira, he paid 950 naira. Instead of paying 900 naira, this person now pay more, or we have more in our debtors. He's now paying how much now? He's paying 800 naira. This person now paid 800 naira and now bought another worth of goods, additional worth of goods again. He now bought additional worth of goods, maybe another 500 naira, additional worth of goods. So here in this case, we have an increase in provisions. And when we are having an increase in provision, we will be stating that the 500 naira, the additional 500 naira that he bought, we will also be increasing it maybe by 10%, by saying that this person would not always be able to pay 100% of what he's buying, but he can afford to pay 90%. Literally what I'm saying is that in the first year, he bought 1,000 naira worth of goods. We've made a provision of 100 naira, that is 10%, because we believe that he can pay 90% of it. The following year again, instead of him paying up, he bought another goods again, worth another 500 naira. But because we always know that this person will always be affording to pay 90%. So remember, the 1,000 naira now increased from 1,000 naira to how much now? 1,500 naira for buying another goods worth of 500 naira the following year. So because we've actually made provision for 10% in the past year, we are also deemed to make provision for another 10% in the current year of that 500,000 naira, which is 50 naira. So the same thing will also happen now in this case by saying that we are debiting our profit or loss with 50 naira and crediting our provisions account with another 50 naira. Now, what happens to our provision account? Our provision account increases to how much now? 150. That is the 100 naira in the first year and the 50 naira in the second year worth of goods. And this is because we are having increase in provision. Now, in the state whereby we are having decrease in the provision, in what situation can we always have decrease in the provision? Maybe this person now came back to pay his money. Now, out of the 150, out of the 1,500, he could pay 900 naira, or he paid 1,000 naira out of his own money. Remember, we are having how much left? We are having 50 naira left. What are we saying here is we are having 500 naira left. Sorry. What are we saying is that the account that he was owing has now reduced this time around to 500 naira. Remember our provision that we made, that provision of what did you call it now? The provision of 150 naira that we made. Now we can now say that, okay, this provision, let's clear it and reduce it because this person has paid more than even what we even make what we even expect him to pay. Instead of paying 900 naira, he paid 1,000 naira. Then we'll come here and say, okay, our provision for decrease in provision of that 100 naira, we are debiting the provision account that we initially credited, and we are crediting our profit or loss account with 100 naira. As time goes on, we will see a real example, and we will actually treat it. It's actually not voluminous like that and difficult. So I'm having issues with scrolling. Okay, we also have provision for discount allowable. So what is discount allowable? The provision for discount allowable is also charged against profit. When something is charged against profit, it means that it is an expense. Note, when you hear something is charging against profit, we know when something is reducing, the only thing that can reduce your profit is actually an expense. So it is charged against profit, is an expense. These discounts allowable to debtors are considered as an expense, can you see, to the business. And all accounting entry regarding the provision for bad debt are also applied. However, in order to calculate provision for discount allowable, it is necessary to first deduct the provision for bad debt. Note, it is necessary for us to first deduct the provision for bad and doubtful debt, if any, from the debtor's figure. The balance will then be multiplied by the percentage rate of the discount allowable to the debtors in order to obtain the amount of provision for discount on debtors. Okay, let's look at an example. So it won't look as if, why am I speaking in tongues? The following information has been extracted from the Book of Adams Limited on 1st April 2018. The provision for discount allowed was 5,813 naira. Note, the provision for discount allowed was 5,813 naira, and the provision for bad debt was 2,234 naira. Discount allowed during the year to 31st March 2019 was 18,824 naira, and bad debt written off was 4,832 naira. On 31st March 2019, debtors amounted to 425,052 naira. The provision for bad debts is to be based on the specific provision of 5,052 naira and general provision on the remainder at 1%. The provision for discount allowed is to be 2%. Now, prepare bad debt account, provision for bad debt account, discount allowed account, provision for discount allowed account, and statement of financial position, all in this small question. Wow. Wow. So do you think this is difficult? Let's see. So the first thing we are going to be opening is our bad debt account. Now, what does the question tell us about that bad debt? It says that on 1st of April 2018, the provision for discount allowed was 5,813 naira. That's not even talking about bad debt yet. It said the provision for bad debt was 2,234 naira. This was on the beginning of the year. Discount allowed during the year was how much? During the year 31st March 2019 was 18,824, and bad debt was written off. That was written off was 4,832. Now the bad debt was written off. A bad debt was actually written off. On March 31st, On March 31st, 2019, a doubtful debt on March 31st, 2019, debtors amounted to 425,052. The provision for bad debt is based on one, the specific provision, and two, the remainder is the general provision. The remainder is the general provision for doubtful debts. So what does this question tells us here is that how do we calculate our bad debts in this case? So our bad debt will be 482,000. Remember, we are actually going to be writing off this bad debt from our trade receivables. We are going to be writing off this bad debt from our trade receivables, which is 484,832 naira. And also, do you have any expense relating to our provision for bad debts? It says here that the provision for bad debt is to be on specific provision of 5,052 and the general specific provision of the remainder. Then how do we get the specific, the general provision of the remainder? First thing we need to do is to remove 5,000 from 425,000 in the first place. So by removing that, what do we have left? If we remove 5,000, and 52 from this, we will have 420,000. So if you're having 420,000, I'm coming. I need to apply my calculator in here. Our bad debt is 482 times, what is our 1%? So we have 0.1. Sorry. Our provision, the provision for bad debt is based on this 5% and the remainder on this. So let's say 5.2. So if our debt or trade receivables is this bad debt, sorry, so we have our bad debt to be 482, yes, 404,832. Then we need to calculate our provision for bad debts, which is 5,000 plus the general provision of the remainder. And the remainder should be 1% of 420,000, and 1% of 420,000 should be giving us 420 naira. So what is 420 naira plus 5,052? 420, that is 5,500 and sorry, I need to do my maths correct. Provision for discount allowed is Three, 1, 6. Okay. No, it's discount allowed. So what is our discount allowed? 18,803, 7. We have an opening balance of this amount, and do you have a closing balance? Discount allowed during the year was this, bad debt written off was this amount, and the debtors amounted to this specific provision with this amount. Okay. So the figure in this place is actually not supposed to be what it is. I think there must have been a typo in this place. There must have been a typo in this set of equation. Apologies. Say yes. It is one. Yeah. 0.01 times 5, because the answer should be 5052 plus 420. That is 5472. So what should be here should be 5472. You're supposed to be having provision for bad debt here to be 5472. And the reason is the specific provision here is 5,052, and the general provision on the remainder. The remainder is on this debtors amount. So the moment we subtract the provision from this, what then do we have? We have 420 naira. So we find 1% of that 420 naira, which is 420,000, which is 420 naira. the 420 plus this 5,000. This 5,000 should be giving us 5,472. Should be giving us 5,472. Hence, the addition of 5,472 plus the trade receivables, the bad debt itself, the one we wrote off. So this should be giving us 10,304 naira. 10,304 naira. That is what this side is supposed to be giving us. 10,304 naira. Now, going to our provision for doubtful debt itself, this place. So we have the opening balance. Remember, the opening balance for provision for doubtful debt is 2,234 naira, which is the opening balance, basically. And the reason why it is on the credit side is because we are making provision for it. And if you are making provision, it's a liability. Yet, so we are making provision for it. That's why it is on the credit side. 2,234 naira. Also, we are also making provision for this account, the provision for bad debts and the general provision for the 1%, which was the 5,472 naira we got, and not 6,000. 5,472 naira. Note that 5,000. Let me see if I can even add a note here. No, I can't. So 5,432 naira. 5,472 naira. And our closing balance is going to be the addition of those two. 5,472 plus 2,237. So we should be having 7,706 naira. Is 7706. That should be what is on this total. Remember, what should be on this total is 10,304. While what is on this is 7706 naira. Okay. So for our discounts allowed in this case, what is our opening balance for our discount allowed? I think we also have a discount allowed here. Provision for discount allowed as opening balance is 5,830 naira. Okay, that's for provision for discount allowed. 5,830 naira. Then what is our provision itself? We have provision to be 2%. 2% of our debtors. What is the 2% of our debtors? Now remember, our debtors comprises of 425,052 minus, say, I'm coming, just give me 1 second. Let me correct this. My calculator is just giving me a digit. So I'm coming, 1 second. Yes. So for our debtors, what's our debtor? We have our debtors to be 4,25052, right? So from 4,25052, what's this thing pressing now? 425,052 minus what is our bad debt? Our bad debt is how much? Our bad debt written off is 4,832. 4382. 4382 minus, remember, our specific provision. So what is our specific provision? 5,052. Remember from what we were reading up here, it said that, however, in order to calculate provision for discount allowable, it is necessary to first deduct the provision for doubtful debts, if any, from the debtor's figure. The balance will then be multiplied by the percentage rate of the discount allowable in order to obtain the provision for whatsoever we're saying. So that is what we are removing. We are removing the provision for the bad or doubtful debt of 5,052 minus, remember the 1% of 420 that we're talking about, 420. So we have 415,198. 415,198. And if you multiply this by the 2%, what is the 2%? So we have 8,303.96. 8,303 naira. So that should be what should be here. Something is wrong with this typo here. Or probably this is another, not, should. So we have 8,303 naira from what we have here. And the addition of these two will give us 14,133 naira. The addition of these two will give us 14,133 naira, which is what we are pasting in here as our closing balance. The corresponding entry then comes to our discount allowable. Our discount allowable. So what is our discount allowable itself? 18,824. During the year, the discount allowed during the year was 18,804 naira. So this was the trade receivables of accounts payable, account allowable. Then we add them together, we bring it to our POL account as 20,000. Then how do we treat our balance sheets? Our statement of financial position, our trade receivables, 401, 401,396. How do we get the 401,396? Remember, we have removed our bad debts from it. So if you remove our bad debts from this figure, that is 425,052 minus, no. This should be 425,052. 425,052. This should be 425,052. Oh, okay. So they've actually removed it. We've opened a ledger of his own. So we have our trade receivables of 425,052, and we have our bad debts. We remove our bad debt of 4,832, and we remove our discount allowed of 18,000 from the equation. Then we have a closing balance of 401,396 naira. I'm sure that you can still remember where these figures are coming from the equation directly. 4,832. 832 and 18,824 naira. So we then have trade receivables to be 401,396 in our statement of financial position. We have our provision for doubtful debts. And what's our provision for doubtful debts in this case? Our closing figure. Do you still remember our closing figure for this provision for doubtful debts? It's not this figure that we have. Remember, I said what we have here was supposed to be 8,000 plus. So we have 10,000 plus around this place. So we have the total figure for our doubtful debts, and we have the total figure for our discount allowed in this question. Then the difference between 401 from our provision for doubtful debts and our provision for discount allowed is going to be the balance that you are having. Let's look at this question. Probably, I hope the solution of this is moderate, so we can get a clearer picture of this question. Umar Nuru has been in business for several years, dealing in the sales for second-hand clothes. During the 3-year ended 31st October 2019, he presented the following information: debtors, bad debts. Now note, this debtor said is including the bad debts. We have 31st 2017, 31st 2018, 31st 2019. You are required to show the above information for year ended 31st October 2017, 18, 19, trade receivables, bad debts, and statement of financial position. Now, in here we have trade receivable for 2017. We have what do we have for 2000 closing balance? 4.5 million. We debit our 4.5 million. We credit our 1.2 for bad debts. Then we assume that the closing balance is the difference between 4.5 and 1.2, which is 3.3. The same thing applies to 2018 and 2019. However, in 2018, remember that we'll be having a balance brought forward in 2018. What's our balance brought forward? Is this 3,000 and 3,300,000, which is what we have in our opening balance, plus the existing sales we made during the year. That is 5,450,000. How do we get this 5,450,000? If we are saying that the closing balance is 8,750,000 naira for 2018 October, then we are assuming that the difference between the opening balance and the closing balance will be the sales for the year. Will be the credit sales for the year, and that is what is here basically. So the credit sales is the difference between this 8,750,000 from our 3,300,000 as opening balance, which is the credit sales. But we still have our bad debt to be what? 3,850,000 naira. This is it. And the difference between this and this 8,750,000 naira is 490,000. 4,900,000 rather. Hence, what's the opening balance for 2019? The same thing. Remember, the closing balance here is 12,200,000. 12,200,000. Then We have the difference between 4.9 and this 12 million is the sales during the year of this 7.3 million. Okay, what can we then say? What is the bad debt for the year for that particular period? 6.3 million. So that's why we are crediting 6.3 million. Yeah, the difference is the actual closing balances of 5.9 million. This is our trade receivables account. Then how do we get our bad debt account? The first year, what was our bad debt? Our bad debt for the first year was 1.2 million. And we are closing the account to 1.2 million, right? And the second year, what was our bad debt? Our bad debt is 3.85 million. Sorry, this is also a typo. So this should be 3.85 million. So this is our bad debt for the second year because it's an expense. And on the third year, we have 6.3 million on the third year. And we are bringing the corresponding entry to POL account. So our POL account will show, statement of profit or loss account will show that in year 2017, we debit our bad debt as 1.2. In year 2018, we debit as 3.85. Is it 3.85? 3.850 thousand. And on the third year, we debit at 6.3 million. Remember, the first one was including bad debts. Now let's look at another question that is excluding bad debts. What are we saying is that Funtua Limited has been in business since 2012, dealing in the sales of mobile phones. During the 3-year ended 31st December 2014, the company presented the following information relating to debtors, excluding bad debts. You have similar thing in that place. However, Funtua Limited makes provision for doubtful debt at the rate of 6% on debtors. There was no balance for provision for doubtful debts at the beginning of 2003 financial year. Okay. So you are required to prepare bad debts. You are required to prepare bad debt, provision for doubtful debt. You are required to prepare profit or loss account. So this is also another question for you to probably, you can also look at. But in here, how do we treat this one? This, remember, is that this is excluding bad debt. So what we are just literally saying here is that this figure, we've already taken care of what bad debts in it. So there's no point recognizing bad debt in our ledger. What we are literally saying is that, for example, this 7 million in 2012, if 7 million was supposed to be the opening balance here, then it's going to be the closing balance because we've actually deducted bad debt already. So there's no point actually including 1.2, deducting it from the 7 million in this question, except we add 7.7 million plus 1 million, and we turn it to our opening balance to account payable as 8 million. Then we come here and say bad debt of 1 million naira. So we can have the closing balance of 7 million. And the same thing also applies to 2013 and 2014. It's not a rocket science. You can also look at question 4 and try to understand bad debt and provision for bad debt. Just know that once it is bad debt, you are deducting it from your trade receivables. If it is provision for doubtful debt or bad debt, then you are always going to be making provision separately. It won't affect, the figure will not affect your income, is trade receivables account. You're just making a direct provision account, and you are crediting the provision account, and you are debiting the P or L account. Okay, to the second section of today's class, let's look at accruals and prepayments. What is accruals? What is prepayment? The concept of accruals is based on the premises that income and expenditure are recognized when they are generated or incurred, and not when money is actually received or paid. Now, what this is actually telling us is that records in accounting is not on cash basis. So definitely it is when an expense is being incurred that we recognize it in our book. So either we pay or we do not pay. It's left to us to recognize the other leg as either our suppliers or not. Now, what are we saying in essence? Is that the origin of the presence of receivables and payables in the midst of ledger accounts and the final accounts, like rent, interest, bills, dividend, commission, are normally being affected by the same accruals. For example, your rent is actually supposed to be on a monthly basis, but because you've actually paid for a full year, so the money you paid is actually in advance. But we are still coming back to that. Now, for example, after you've paid, after apologies, the network went off. Okay, so on this basis, you are supposed to be paying rent of 120,000 per annum. That is 10,000 naira a day per month. And you use only 3 months and you are yet to pay. So how much will they consider that you are owing? It means that you are owing 30,000 naira. This 30,000 naira is called owings. So another word for accrued is called owings, which is a liability. Said rent, interest, bills, dividend, etc. are normally being affected by the issues of accruals. Okay, now let's go. The concept of prepayment here is that prepayments are about payments that we made in advance, just like the rent I said, or to the business. If out of the payment made by the business on an item of expenditure, if out of the total payments made by the business on an item of the expenditure, a portion is not for accounting period, then the amount is called prepayment. What are we saying here is that you are owing rent from July this year to June next year for 1 month, 1 year. For 1 year at 220,000 naira. Your reporting date, your accounting ended reporting date, we end December 31st, 2021. And you've paid this 120,000 rent in July. It means that you've paid for a period of months that does not reflect in our accounting year. In other words, we've paid in advance rent for January, February, March, April, May, and June. So those 6 months, we divide the amount by the number of months, the total we get, we treat them as payment in advance, which is prepaid. For example, why do you think they start calling NEPA lights your meter, prepaid meter? It's because you've actually paid ahead of usage. Unlike before, that until when we use it, that is when we pay. Now, it is you paying before you even use it. So that is what prepayment is, paying in advance. Accounting treatment for accruals. Income is generated, but money is not yet received. And this would be recorded as income in the income statement as income received. And it would be recorded in the statement of financial position, current assets, as an expense. Expense incurred, but money not yet paid will be recorded in the income statement, just as expense paid for, and will be recovered in the statement of financial position under current liability. So you incur an expense that you are yet to be paid. So it is called owings, accrued. So how do we treat this? We put it under current liability. If money is paid on rent, the rent account is debited is to debited and the cash book is to be credited. If money is received on rent, cash book is to be debited because it's the one that they are receiving it, and rent to be credited. So we are saying if money is received on rent, cash book is to be debited and rent received is to be credited because we are receiving cash and we are also receiving money for rent. So that's why we are going to be debiting the cash for receiving the cash, and we are debiting the rent payable account so as to go and clear up what we are owing. Accounting treatment for prepayment. If out of all total journals made by the business on an item of expenditure, the portion is not for the accounting period, the portion of the amount, a portion is not for the accounting period, the portion of the amount paid in advance will be deducted from the total before taking into the accounting statement. Okay, let's look at this illustration. Uche set up business on 1st January year 1. The business has a December year end as their year end. The business acquired a telephone system on 1st February. Telephone charges are paid every 3 months in arrears, and telephone invoices are received as follows. The next invoice is year 2. The statement is expected to be 9,000 naira. Year 2 invoice. The next invoice will be paid in year 3 is how much? So telephone expense. What do we do here? In year 1, what happened in year 1? Remember, telephone charges are paid every 3 months in arrears, that is after usage. Telephone invoices are received in year 1 as follows. So these are the invoices we received, and the next invoice is expected to be 9,000. This is the next invoice here, which we expected. And the next invoices is expected to be 10,500 naira. This is from the question, actually, not from the solution. So we have telephone expense, bank, 7,500, 5,000, 8,500. in year one, because this guy will be paid in year one in arrears, in year two he will be paid, in year three he will be paid. But how much is he going to be owing by year four? By January 2. So it means that in November, December, and January, we used, what do they call it, 9,000, right? And we are only reporting up to December. So if we are to divide this 9,000 by 3, how much will it give us? To give us 3,000. And are we reporting for November? Yes. Are we reporting for December? Yes. Are we reporting for January? No. So we are only reporting for 2 months. And this invoice comes in every 3 months. So we need to recognize our 6,000 naira, which is accrued. And then the balance is what is taken in. The same thing also applies to year 2, every 3 months. But remember, the opening balance here is 9,000. And if the opening balance is 9,000, then we can come here and bring the accrued balances of 6,000 naira as a corresponding entry. So because they must have paid this 9,000 naira now, so we have another April of 95, which must have been paid. July, it must have been paid in the next 3 months. October, must it have been paid? So we have October, November, December, January, the same 3 months. And we're expected to receive 10,500 after the 3rd month. So after the 3rd month, we can't do a proper accounting until we prorate this 10,500. So we divide 10,500 by 3 and then multiply it by 2. So if we divide 10,500 by 3, should be having 3,750. $3,500 rather. If we having 3,500. So 3,500 times 2, because we are reporting for January, December, and November, which is the 7,000 naira. Which is the 7,000 naira. By the time you add all these 3 together and subtract it from your 6,000 naira, you have your POL to be 39,500 naira. Accruals account. What do we do to accruals account? At the end of the year, we said we are owing 6,000 naira. We close it. In the beginning of the year 2, remember we have opening balance of 6,000 naira. We had a reversal of 6,000 naira. Remember, this was 6,000 naira. Because we are bringing in a full amount here. Then we have telephone to be 7,000 naira accruals again. And we have 7,000 there. Opening balance as at 2013. Year 3 is 3,000, 7,000 there. Can we look at question 2? Moses set up in a business on 1st January year 1, preparing financial statements on 31st December each year. On 1st March, he obtained annual insurance on his office building starting from 1st March at a cost of 24,000 naira, payable annually in advance. Year 2, the annual subscription payable on 1st March is 30,000 naira for year 2 to 28th February year 3. Calculate the prepayment amount and show the accounting treatment. Now, what does the first year say? He paid 24,000 naira, okay, at cost. So payable in advance. And that is 1st March. His closing period is December. So how many months will he be recognizing for this year? He'll be recognizing for 10 months. 24,000 naira is for 12 months. So if we are going to divide 24 divided by 12, it's going to give us 2 times the 10 months that he actually utilized. That's 20,000 naira. That's how we got this 20,000 naira. And the prepayment is actually the difference between the 20,000 and 24,000. That is the month that he carry over to next year, which is January and February. So which is the 4,000 naira difference. Now, the opening balance will be 4,000 naira prepayment plus his new annual premium insurance again for another 12 months of 30,000 naira. So we do 30,000 naira divided by 12 times 10 is giving us 29,000 naira. 29,000 naira is the premium amount that is paying for this particular year. So from March to 31st, 30 March, that is how many months? That is 12 months, right? And 30 divided by 12 is that much. So this is 30 divided by 12. $30,000 divided by 12. That's 2,500. So 2,500 times times 2. Remember, because we only utilize March to December, so it remains 2 months. So 2,500 times 2, we have a prepayment for how much? We have a prepayment of 5,000 naira. If we are to remove 5,000 naira from this 30,000, we have 25,000 naira. 25,000 naira plus, remember that 4,000 naira outstanding is what makes up 29,000 naira. Then we have our year 2 closing balance. So how do we treat our prepayment? Our prepayment, we have expense of 4,000 naira. Remember, we need to bring it back as our opening balance in year 2, and we come here to close it or reverse it. And we have another insurance expense of 5,000 naira here, the corresponding entry. And we have a closing balance of this. So we have 9,000 naira. So our opening balance as at year 3 is 5,000 naira. That's our closing balance for year 3. So basically, when you say accrued, it means you are owing. And when you say prepaid, it means that you are paying in advance. And accrued is actually a liability, while prepayment is actually what? An expense. So we continue again on Friday, hopefully, and here ends the class. And let's continue on Friday, hopefully. Thank you.